Ladies and gentlemen, the dollar is tanking and markets are surging. So why exactly is this happening? Why is the US dollar tanking? Why are markets surging? Is there something we're missing here? Well, everyone, I've been doing extensive research over the past few days, and the real answer may shock you. Because what you have to know is we're at a huge pivotal point in history right now, and also the bigger 40-year cycle. We have so many risks right now, like inflation, commercial real estate markets tanking, bank failures, high interest rates, and central banks doing some of the most aggressive quantitative tightening cycles they've done in modern history. But despite all these risks, the markets are still melting up. So are the markets right or are the markets wrong? How can we protect ourselves against a tanking US dollar, and is it too late to jump in on this rally? Well, everyone, this is going to be one of my most important videos, so you're definitely not going to miss this. So let's not waste any time. Let's get straight into the news, the facts, and the data. So first things first, what we have to talk about is we already did have two stock market crashes recently. We had one like I talked about in 2020, and also like I warned about the stock market crash that would be coming in 2022. The S&P 500 fell around 30%, the Nasdaq fell around 40%, and we did actually have a recession of 2 negative quarters of GDP, but then all of a sudden the Biden administration changed the definition of a recession. Now, what you have to know about the stock market and all other markets is they are not the economy. So the economy could be doing poorly and the markets could be doing great. But then on the other hand, the economy could be doing great and then all of a sudden central banks start hiking interest rates like they've been doing, start quantitative tightening, and then the markets tank. But what you have to know about the markets is they're forward looking. They're trying to predict the future, normally 6 to 12 months in advance. So that's why we saw the stock market crash last year in October, because they were trying to price in all these Federal Reserve rate hikes and also a deteriorating economy. But now what the markets are pricing in, they're starting to price in Federal Reserve cutting interest rates and also the economy doing much better than expected. But there's so much more than that, people. So let's have a look at some of the recent data that came out that is quite bullish for the markets. So first things first is the United States Michigan Consumer Sentiment. So the University of Michigan Consumer Sentiment for the US increased for the second month to 72.6 in July of 2023, the highest level since September 2021, and well above the forecast of 65.5. Now, yes, this is better than expected, but if we zoom out here, we can still see this level here, it is well below the average of 100. So consumers are still weak, but it is rebounding. Now, next, we also got GDP data that came out, and magically the first quarter GDP was revised upward from 1.3% to 2%. And that means a lot of people on Wall Street thinks there won't be a recession this year in 2023. And it was the upward revision in consumer spending and inventories boosted the revised number. But that's not all. A lot of people are getting bullish because inflation is falling, or should I say the CPI is falling, and they actually changed the way they did it again in January this year. So inflation just rose 0.2% in June, less than expected as consumers get a break from price increases. Now, core inflation is still very high at 4.8%, and workers' wages adjusted for inflation only increased 1.2% from a year ago. Now, I think you know and I know that the real inflation number is much higher, but on Wall Street, they only care about the official CPI release. They're completely out of touch with reality, so if they see a low print, the algorithms go ahead and buy. If they see a print that's higher than expected, then they go ahead and sell. Now, another thing that Wall Street is liking is US retail sales ride modestly and the economy is plodding along. So this is adding to the bullish thesis that the economy is not as bad as we thought it would get. So retail sales increased 0.2% in June, and core retail sales rose 0.6% in May data revision. But we're continuing to see manufacturing production fall, and that's not good. So on paper, it looks like the economy is doing okay, despite the Federal Reserve doing their most aggressive rate hike cycle in history, and even me, I am very, very surprised, and all the analysts on Wall Street and all the bankers are surprised how resilient the economy has been despite interest rates going from 0 to 5.25%. But something they're not really thinking about is, yes, the economy is growing at 2%, but inflation is 4.8%. So that is stagflation because the inflation rate is actually higher than the GDP number. And another reason why GDP is growing around the US and Australia as well is because of record migration. They're bringing more people in, and this is making GDP GDP better than it would be per capita. Now, also, we're in earnings season right now for the stock market, and a lot of companies are beating expectations. But what's really happening is a lot of companies put their expectations so low, it was going to be very, very easy to beat. So say, for example, last quarter, Amazon made $10 billion, for example, in revenue. And then they put out an expectation that in this quarter, they'll only make $8 billion in revenue. But then it comes out, they release their earnings and they actually made $9 billion. Well, then you'll see all these headlines that Amazon beat earnings expectations and it sounds like everything's great. Well, no, in real terms, their revenue was actually down 10%. And we also saw a report from Goldman Sachs, their profit fell 58%. So unlike the mainstream media, the news analysts, the people on Wall Street are saying the reason why the markets are surging is because the fundamentals are so good and the economy is great. No, it's really for one reason and one reason only. That's because the US dollar is collapsing. And what you have to remember is all major assets around the world are priced in US dollars. So when the US dollar falls, the price of these assets surge. But before we get into this mind-blowing US dollar report, a quick word from today's video sponsor. Are you tired of your personal information being sold online without your knowledge? Do you want to take control of your privacy and protect your data? Well, that's why I'm proud to work with today's video sponsor, Incognito, the solution to your privacy concerns. It's no secret now that your personal information is being sold every single day by data brokers without your knowledge. But here's the good news, you actually have the right to request that your data be removed. But the problem is, manually contacting each data broker will take years of your precious time because it's happening on such a mass scale. But that's where Incognito comes in. They're here to do the messy work for you. Incognito will reach out to data brokers on your behalf and request that your information be deleted from their lists. No more hassles, no more stress. With Incognito, all you have to do is create an account and watch the information you want removed get deleted. Grant Incognito the right to work on your behalf. Sit back, relax, and let them take care of absolutely everything. Because I don't know about you, but nothing annoys me more than those annoying robocalls and my inbox being flooded with scams. We'll say goodbye to all of that because with Incognito, it helps you regain control of your privacy and reduce unwanted solicitations. And guess what? For my subscribers only, they've got an exclusive offer for you. The next 100 people to click the link in the description below and use code Cowan at checkout will receive a massive 60% discount off Incognito services. Don't wait any longer. Take action today and get off those data broker lists. Protect your privacy with Incognito, your data, your control. So the tumbling US dollar, a boon to risk assets across the globe. So what you have to know is the more the US dollar falls, the more these risk assets like tech stocks, cryptocurrencies go up even higher. Because I'll bring up a chart here, everyone. We can see when the markets bottomed in October, that was when the US dollar, the DXY, was at its strongest. On the 27th of September, it reached a high of 114 and it was around 111 to 113 in October. That's when the markets bottomed. But as you can see, this is 100% correlated. As the US dollar started to tank, the market started to surge. And the US dollar has fallen around 15% and it broke the 100 level. And if it does break this again, we could continue to see the dollar collapsing even further. So again, look at this chart here, the dollar tanking. And look at this chart here, the NASDAQ 100 absolutely surging on top of the AI hype, which is actually, I'll go into later in the video, if the AI hype is real or not, and if you should be buying. But let's get deeper into this report on how bad it could be for the US dollar. So cooling US inflation is accelerating decline in the dollar and risk assets around the world stand to benefit. The dollar is down nearly 13% against a basket of currencies from the last 2-decade high and stands at its lowest level in 15 months. Its decline quickened after the US reported softer than expected data on inflation on Wednesday, supporting views that the Federal Reserve is nearing the end of its interest rate hiking cycle. So what you have to know is when a country lifts interest rates, then that means it makes it more attractive for people to invest in their currency. It makes their currency more stronger. But now the markets are actually pricing in that the Federal Reserve will start cutting interest rates next year, or they may not do any more rate hikes anymore. Because the dollar is a linchpin of the global financial system, a wide range of assets stand to benefit if it continues falling. Weakness in the dollar can boon to some US companies as weaker currency makes exports more competitive abroad and makes it cheaper for multinational companies to convert foreign profits back into dollars. And I'll go into at the end of the video which assets will benefit the most. Raw materials which future price in dollars become more affordable to foreign buyers when the dollar declines. The S&P Goldman Sachs Commodity Index is up 4.6% this month, on pace for its best month since October. Emerging markets benefit as well because a failing US currency makes debts denominated in the dollar easier to service. The MSCI International Emerging Market Currency Index is up 2.4% this year. Now, emerging markets will definitely be happy with this because they were in debt up to their eyeballs, and the high US dollar was making it very hard to service their debt. For markets, the weaker dollar and its underlying driver, weaker inflation, is a balm for everything, especially for assets outside the US. The greenback's tumble has come as US Treasury yields ease in recent days, dulling the dollar's allure while boosting a wide range of other currencies from Japanese yen to Mexican peso. The sound you hear is the breaking of technical levels across the foreign exchange markets. The dollar is plunging towards levels that prevailed before the Fed started hiking, and we're seeing risk-sensitive currencies melt up on a global basis. So this is exactly what I've been warning about, everyone. I've been saying if the Federal Reserve does not lift interest rates to what level they need to bring down real inflation, not the CPI inflation, we're going to see a huge market melter. When you look at what's going on right now, the outlook for the dollar remains pretty bleak. And I'm not even going to try to pronounce this name here, everyone, who expects to carry trades to thrive if the dollar keeps falling. So everything seems quite bullish right now, but there are still risks that we need to pay attention to. Of course, being bearish, the dollar has its own risk. One is a potential rebound in US inflation, especially with base effects, which could stoke bets on more Fed hawkishness and unwind many of the anti-dollar trades that have prospered this year. Though inflation has cooled, the US economy has remained resilient compared with other countries, and few believe the Fed will cut rates anytime soon, which could potentially limit the dollar's near-term downside. That's exactly right. If the economy is doing great, really the Federal Reserve shouldn't cut rates, but the markets don't believe them, and I don't believe them either. Still, Helen Given, FX trader, believes the Fed will wrap up its rate hike cycle before most other central banks, sapping the dollar's long-term momentum. While the dollar may pair some of its recent losses, looking 6 months out, it's likely the dollar will be even weaker than it is today. Now, on top of this, everyone, a couple other risks I'm watching very closely is the commercial real estate market, which is absolutely tanking right now, and if this causes huge losses on the banks, we could see more banks fail and lead to another global financial crisis. But what the markets are saying and thinking, they're saying, look, don't worry, if the commercial real estate market collapses, that's great because then interest rates will be dropped to zero, the Federal Reserve will go ahead and print more money, and that's going to make the US dollar fall even more. Because Wall Street has become little snowflakes, and I think central banks have become little snowflakes. Market crashes were very normal during the early 1900s and mid 1900s, but it seems like now nobody wants a downturn, they only want markets to keep going higher. Now, another risk is the lag effects. I don't think we've felt the full pain from interest rates being above 5%. And if the Federal Reserve doesn't cut interest rates early next year, well, there's going to be more pain, I think, during the first quarter of 2024. And this one indicator that has predicted every single recession is still flashing code red. Look at this, everyone. This is a 10-2-year Treasury yield spread called the yield curve inversion. We can see here it has been inverted for over a year and is now at the steepest inversion since the early 1980s of 0.99%. But there's one last big bet that Wall Street is hoping on that will fix everything, and that is AI, artificial intelligence. Now, I've been using AI and I've been using a lot of these technologies, and it's completely blowing my mind. So I think the AI hype is real. If you just go ahead and use things like ChatGPT, I've been playing around with some of the video editors, some of the text to images, some of the text to video. Now you can just type a prompt and then create entire videos. It is absolutely insane. I think it is going to change the world. I'm very worried. I'm worried about my job. I'm sure a lot of you are worried about your job. But the factor of the matter is this is going to massively boost companies' profitability. They will not need to hire many more workers, and it's going to be massive layoffs, and it's going to increase companies' productivity. So what I think a lot of people on Wall Street are doing to hedge against themselves becoming obsolete is they're going all in on these AI companies. Now, this will lead to a huge bubble, just like in the year 2000 with the internet, with a lot of people doing the same thing then. But I do still think we're at the early stage of this bubble, and the AI bull run still does have legs to run, but it will lead to a huge collapse after we see this massive market melt up complete. So I know what you're thinking, everyone. Well, okay, how can we protect ourselves against the dollar collapsing and also against artificial intelligence? Well, first things first, for the dollar collapsing, you're going to want to have other alternative assets, and real money. That is gold and silver. Every single currency that's failed, people have always flocked to gold and silver because it stood the test of time. Also, as the dollar collapses, that's very bullish for Bitcoin. I think Bitcoin will outperform gold and silver, but it's very risky, so I only allocate 20% of my portfolio to Bitcoin. Now, at first, I thought this AI was just all hype, but as I've been using the technology, I'm seeing how revolutionary it is as I've been doing more research and having a look at more and more experts on how much AI is going to change the world, and it's not just hype, it is real. I'm also buying AI stocks. I'm allocating about 10% of my portfolio to AI stocks because I need to hedge myself against, who knows, maybe YouTube will cancel content creators and they'll just only have artificial intelligence content creation in the next 10 years. I hope it doesn't happen. I don't think it will happen. I don't think it'll get to that level, but there is going to be a lot of creative destruction. I'm sure the government will jump in to try to protect jobs, and I actually think it'll be a lot of white collar jobs, not blue collar jobs, that will be taken first, unlike what a lot of people expect, but there's no avoiding it. Anything you can do in front of a computer, AI will probably be doing it in the next 10 years. That's why it's more important now than ever that you need to create wealth. You need to have a portfolio where your money worked for you. You no longer have to work for money. Because if you have a $2 million portfolio returning you 5 to 10% per year, well, you can simply retire on $100,000 to $200,000 per year. And even if there's artificial intelligence out there in the world, you will still be fine. Now, if you're wanting to learn how to build wealth and master the cycles of gold and silver and Bitcoin to get to that $2 million portfolio, so you no longer have to work again, so you don't have to worry about artificial intelligence, well, you can click the link in the description below. My course is 50% off right now. It is still in the pre-launch phase. Once it is finished, the price will be doubling. Again, if you're wanting to protect your privacy and data, click the link in the description below to get the 60% discount off with Incognito. Thanks for watching. You're awesome. I'll see you all in the next video.